Good morning. Calling to order the February 11th, 2026 regular board meeting of the Marin County Employees Retirement Association. Mr. Administrator, would you call the roll?
Trustee Cooper.
Here.
Trustee Helway is here. Trustee Martinovich.
Present.
Trustee Poole.
Here.
Trustee Robbie.
Here.
Trustee Silverstein.
Here.
Trustee Vasquez.
Here.
Trustee Vila is absent. Trustee Werby.
Here.
Trustee Healy.
Here.
Trustee Jones.
Here.
Trustee Shaw. Chair, all members of the board are present except for Trustee Vila.
I understand we do have a request for teleconference.
That's correct. We'll bring in Trustee Helway, who will be attending remotely, and he will provide the board with the requirement that he notify you of the reason for the remote attendance under the Just Cause provision. Trustee Helway, go ahead. We can see you. If you can provide the board with the information about why you're attending remotely.
Yes, good morning. Well, unfortunately, I contracted COVID and I tested COVID on Sunday. I have symptoms, heavy symptoms, so I thought I should not be among people. So that's why I need to join today remotely. I'm in a room, an office, home office with nobody else in the room. I also request that I be off camera. I'm coughing a lot until and then I have to vote or I have to speak. I'll turn on my camera.
Okay. Thank you, Trustee Helway.
Thank you for joining and thank you for joining remotely.
Thank you.
Moving along, we have the, has everyone had a chance to look at the minutes of the January 14th board meeting?
Yes. Sorry.
Trustee Helway?
Yes, I did.
Go.
Silverstein will move to approve the minutes of the January 11th board meeting, 14th, sorry.
Robbie, you will second that motion?
Any discussion? All in favor?
Aye.
Mr. Chair, the motion to adopt the January 14th, 2026. Apologize, Mr. Chair. Because we have somebody attending remotely, we have to do a roll call for the vote. And we'll have to do that for each of the votes.
Okay.
So I will call your name if you are in favor of the motion. That's the first thing, is all those in favor. Trustee Cooper?
Yes.
Trustee Helway?
Yes.
Trustee Martinovich?
Yes.
Trustee Poole?
Yes.
Trustee Robbie?
Yes.
Trustee Silverstein?
Yes.
Trustee Vasquez?
Yes.
Trustee Jones?
Yes.
Trustee Werby?
Yes.
Mr. Chair, the motion to adopt the January 14th, 2026 meeting minutes passes unanimously 9-0. Trustee Jones voting for Trustee Vila.
Bring this to open time for public expression. In matters of general interest, we have a rather full agenda today, starting with the actuarial valuation.
Good morning.
Morning.
To answer the question about what happened, I had another board meeting and I told them how good your funded ratio was, and they tried to rip my arm off. No, actually, Jeff came up with that one.
My joke, yeah. I told him to spin it the other way. Their funded ratio was not as good as they wanted, and so
we are here to deliver the final valuation report. A rotator cuff repair. That's what it was. We are going to focus. So the actual evaluation is trying to tell three stories, right? Where are you? Where is the plan? How did you get here? And where is it going? When we gave the preliminary results in December, we pretty thoroughly covered the where are you and how did you get here, right? What changed from last year to this year? Nothing has changed between that presentation and this final report. So we're going to focus today more on the where are you going, and Bill is going to give some information on some of the risks to the plan going forward. But I will briefly cover some of the key results that we looked at last time. Do I need to do something to share this on the screen, or?
While we have a break, I can no longer see Trustee Helway. If He needs to have a question or something. How do we handle that?
You should be able to hear you.
I'm here.
We can't see.
Yeah, I know, but I couldn't see him if he.
Yeah, I'll change it so he's there.
Okay.
Okay, so we are looking at table 1-1 at the outset of the report. And you can see that on the left-hand side is last year's results, the right-hand column is this year's results. And as we talked about last month, the unfunded liability has gone down by about $140 million because the liabilities grew slower than the assets. You had good returns this year. And that funded ratio for the plan as a whole improved by about 4% from 92.1 to 96.1%. We don't do any smoothing on the assets for this plan, right? Some plans use an actually smooth value of assets. You use the market value of assets, which is the assets that go into your financial statements. So you see the full impact of those good returns that you experienced this year in terms of the change in the funded ratio. The contribution rates for the three main subgroups of the plan, which is the County of Marin and the associated special districts. Then you have the Novato Fire Protection District, both miscellaneous and safety employees, and San Rafael City and safety employees. All three of those groups did see declines in the contribution rates, in particular for the city of San Rafael. I will note that in the back of the report, we have lots and lots of tables, which include contribution rate schedules for each and every employer. So all of the special districts included, not just the county. We also have contribution rates for each individual tier, but the rates you're seeing here are the rates in aggregate. We also have the membership, which in aggregate, active membership increased by about 2.5%, which grew a little bit faster this year than the retired membership. And we saw an overall increase in projected payroll of over 6.5% year over year, with the average pay per menu growing by about 4%. So you add that to the 2.5% increase in the active workforce, and that's how you get to the overall increase in payroll. If we skip ahead to the assets and liabilities, we do have separate assets that are tracked by the system for the three main subgroups. And you can see that you have three different funded ratios for those groups. So the funded ratio for the county is getting very close to 100%. It's 98.4. Nevada's at just over 93%, and San Rafael at close to 89%. The number underneath that is what we call the inactive only funded ratio. So that's the percentage of the liabilities that are associated with people who are no longer actively working for one of the employers, right? It's over 2/3 for all groups, right? So more than 2/3 of your liabilities, and almost 80% for the city of San Rafael of your liabilities, are for people who are no longer working. You are a very mature pension plan. One thing is you can look at that comparison of the funded ratio to the inactive funded ratio. If the funded ratio is higher than the inactive ratio, that means that you have at least enough assets set aside to cover the liabilities, the full cost of the expected benefits for the retirees for the remainder of their life. And because you're above that, it also means that you have a decent amount of assets set aside to cover the liabilities for the active members that they have earned. And in the case of the county, it's almost 100% at your target. A question?
What's a healthy ratio across the county plans that you service?
So the average funded ratio is somewhere in the 80s. You are well above that. Healthy is I try to avoid using a healthy funded ratio as a specific one number thing, because that can depend on a lot of factors. What's the financial health of the sponsor? What's the size of the unfunded liability compared to the size of the payroll? But in terms of comparison to your peers, your funded ratio is, if not the highest, near the highest for the 37 Act counties.
Meant for the inactive only funding.
Oh, you are more mature. You are more mature than many of the other systems as well. And Bill is going to talk on that specifically.
Thank
Table 1-4 shows the reconciliation. How did we get from last year to this year? This is where we spent a lot of time last month or in December. So I'm not going to cover this exhibit in detail other than to say all three groups saw reductions in the contribution rate because of your good asset returns, over 11% return. That's phased in over a 5-year period. We did see, you see continual declines every year in the contribution rate as you have PEPR members replacing the legacy. And because San Rafael and Novato had more new hires this year than the county as a percentage of their workforce. They saw a greater reduction there. They also have more safety employees, and that's where you see the bigger decline from PEPRA. The biggest factor is the effect of payroll on the amortization amount, right? The amortization of the unfunded liability is a dollar amount, right? It's what is the dollar amount necessary to pay off the unfunded liability over the plan's, funding policy. If your payroll, and that's meant to remain constant as a percentage of payroll. We assume payroll grows by 2.75% every year. If payroll grows by faster than 2.75%, you'll see a decline in the rate. If payroll grows by less than 2.75, you'll see an increase in the rate from that factor. Doesn't mean the cost is changing. It just means that the cost as a percentage of pay is changing. And in the case of San Rafael, we saw a very big decline because their payroll grew faster than the other groups. That's why you saw a big drop in their rate of over 4% of pay. That gets you to and then other changes in terms of salaries, demographics, retirement rates, all of those things, they netted out to very little. Things were pretty close to what we had expected. We will be doing an experience study next year where we will be reviewing all of the assumptions. But at least within the last couple of years, actually, the experience has been pretty close to that anticipated. Any questions on and this was all the stuff that we covered in December.
And can you refresh us? When was the last experience study?
It's done every 3 years.
Okay, so that covered as of
2023, up
Thank
through
you.
2023. So this one will cover the data up through June 30th, 2026. Okay. A little more of a longer perspective in terms of the changes. Here's a history of the liabilities, the assets, and the funded status over the last 10 years. You have seen an improvement in that funded ratio from over 12%, from under 84% to 96% this year. We do see that big bump up that happened in 2021 when we had really spectacular returns and you got over 100% funded. Things kind of came back to normal the next year, but we have made, if not steady progress, there has been consistent progress over the past decade. Looking at the contribution rates, this is the other side of a really nice story. You've had improvements in the funded ratio at the same time that you've seen declines in those employer contribution rates, right? So at the beginning of the decade, San Rafael's employer rate was over 60% of pay. That's now under 50%, right? So a pretty big decline in those contribution rates as you have continued to pay down the unfunded liabilities. And as the employers have made that progress, you're seeing the amortization periods decline, the amortization payments decline as payroll has recovered. And also as you've seen changes where the active workforce moving towards those PEPRA tiers. All right, now we start getting into the forward-looking view. So here's what I refer to every year as the actuarial fantasy, where we assume that the assets earn exactly 6.75% each and every year. The payroll grows by exactly 2.75% every year. Everybody retires exactly when we expect them to, and then they are going to be replaced by a new member in one of the PEPRA tiers, right? So we know that this will not happen, right? We're not going to exactly hit all of our assumptions in each and every year, but if we were, this is what's projected to happen. So this top projection is showing the contribution rates as a percentage of pay. The gray bars on the bottom are the projected member contributions, and those are expected to remain fairly level. Then the top bar is the employer contribution. You see that at around 19% for the county this year, going up to 20%, then dropping slightly, and then dropping a whole bunch out in fiscal year 2032. In fiscal year 2032, that's when the initial unfunded liability layer that we established in 2013, it was a 17-year layer that will be paid off. We have a 12-month delay in the implementation of the contribution rates. So that's when you see that big decline in the contributions. The reason that you see an increase from this year to next year is because this is the last year where we are phasing in those really good investment gains from 2021. Next year is the last year we will be phasing in the really big losses that we had the next year in 2022. So that's why next year you're seeing a small increase in the rates for the county, slightly larger for Novato and San Rafael. That's because this year we're getting that last piece of the gains. Next year we're getting the last piece of those losses, and we don't have the gains from 2021 to offset that. Does that make sense? Okay. Everything else is pretty stable once you get out past 2023, 2031 for the county. At that point, the plan's expected to be 100% funded. We do have offsetting gain and loss layers that have occurred over the last few years, but none of them are that large compared to the initial layers that we're looking at. So at that point, once the plan is fully funded, with the Pepper employees paying half the normal cost, it makes sense that the employer cost is expected to be roughly similar. For Novato, the rates are higher to begin with because we have these larger unfunded liability payments. You see a much bigger decline out in 2032 because they have a bigger share of that bigger unfunded liability payment that is dropping off. But the same trends are present. We do have, because Novato and San Rafael not only are, they are heavier safety workforces, and in the case of San Rafael, it's a more mature group. You are seeing bigger changes out in the out years as those other unfunded liability layers come on and off, right? Just because they have more assets, more liabilities for every dollar of pay, and that's why you see greater fluctuation in the rates in the future. For City of San Rafael, they have the largest unfunded liability payment. So once that is paid up, once that initial layer is paid off, you see a drastic decline in that contribution rate from 50 all the way down to 18% of pay.
Graham, I do have a small question. I think I understand the math, but what you're telling us is we're reducing contribution rates now with the expectation we're going to have to raise them in the near future?
Yes, and that is part of the actuarial process that we established once we went to this idea of having layers of the unfunded liability and layers of the unfunded liability that get paid off over time, and that get phased in and phased out. So other plans.
I think I understand the math.
Yeah.
But from a budgeting and political point of view, should we be taking that into account at all?
No, because once again, Graham started this chart with, this is not going to be real. Right? Which you already know, your investment returns through December 30th was already 6.4. So if you go over your target again, these numbers will not be exact. They will change, and they could change up or down depending on what your final thing. So the employers do rely on this. So they look at this because they want to know what could happen in certain circumstances. But this will not be the final outcome. And the final outcome could be positive or negative from a contribution standpoint.
Right. I've gone back to the change in the employer rate year over year, right? So that first row this is what happened as a result of the asset changes just this year, just that 111% return. That did reduce Novato's rate by 1.25% and San Rafael's by 1%, right? So that was 1 year return, even though that's phased in over a 5-year period. That's what that impact is. So if you have a similar, you don't hit that expected return, it can have an impact. The other thing is, we definitely don't know what's going to happen. The biggest change in this chart altogether was San Rafael's rate dropping by more than 4% of pay because payroll went up, right? So other things can certainly have an impact on those rates year over year.
But it is, as I said, it is a very valuable chart because employers want to be able to see longer term what might happen.
Right.
It's just the caveat we give them. This is as if everything is hit exactly, which we know will not happen, right? So we can't, we can give you this projection, but know it will change.
But even if good things happen, they'll be phased in over.
They will
time.
be, but if the good thing was a return twice the size of your assumption, then there won't be these rate increases next year.
Right.
So it's valuable, but it's not stale, but it is as of this moment.
Cool. Another question.
Yes. So especially with Novato and San Rafael having that big drop off there, and I guess 2032, you said that's them paying off the unfunded.
That's paying off the initial layer of the unfunded liability. When the plan changed its funding policy in 2013, 2014, they said, we're going to take that amount of the whatever unfunded liability existed as of that date, and we're going to pay it off over a 17-year period. That's the end of the 17-year period that those payments are being made. Going forward, now that the plan has this policy where any changes in the unfunded liability the payments are being phased in over 5-year periods for gains and losses, 3-year periods for assumption changes, you shouldn't ever see that scale of a change in the employer rate in 1 year. That initial unfunded liability had no phasing in or phasing out attached to it. It was just, we're going to pay this off over a 17-year schedule. And once that schedule is gone, that payment is gone. You won't ever see, even if you have a big event, a 2008 type loss, you won't see that level of change in the contribution rates because any change due to the change in the unfunded liability is being phased in and out over those 5 and 3 year periods. So looking for more stable contributions going forward.
How do we inform the employers throughout this process? Refresh my memory. Like, at what points have they gotten updates? Either the process preliminary and then this presentation.
I will defer to staff.
Yeah, so the preliminary report, which was a couple months ago, before you reviewed or after you received the packet with that was sent to employers. So all employers got the preliminary results and all employers got this report, the final results, pointing to both the contribution rates and for those who have asked, and some of the employers did, also this projection chart. So that's been provided to them last Friday.
Okay, so going to the last chart that I'm going to look at are the projections of the assets and the liabilities. And this is telling a very positive story. Within the next 2 years, if your assumptions are met, the county's expected to hit that 100% funding target. San Rafael and Novato, it takes a little bit longer because they have a little longer runway on those unfunded liability payments. But even there, you're expected to be 95% funded within the next 2 to 5 years. Okay. I am going to turn it over to Bill, right? This is what we expect to happen if everything goes as planned and as assumed. He's going to talk more about, well, what happens if things don't go quite as we expect them to.
Morning, everyone. So Graham gets to report on the actuarial fantasy, and I have to bring you back to the real world here. See if I can. So the second section of our report is a risk analysis and looking at what can affect the plans and trying to identify the most significant causes of changes to the plan. Before we get into looking forward, we wanted to just look at what's caused changes in the past. So we're looking at the last 10 years. This is adding everything up. The next chart kind of breaks it out by year, but over the last 10 years, the unfunded liabilities dropped by about $256 million. And these are the sources of that change. And so I'm going to start at the bottom red bar, the contributions. Our contribution policy is designed to pay for the cost of the benefits that are being earned, plus pay down that unfunded liability. And over the last 10 years, we've steadily chipped away at it year after year. And that's added up to a reduction of 231 million. So that's a good, robust contribution policy that's taking care of the unfunded liability, steadily chipping away each and every year. The investment gains over the last 10 years have reduced the unfunded liability by 297 million. That's the most volatile piece. And when we look at the individual year chart, you'll see the biggest swings year by year are due to the investment gains. And so we focus more of the risk assessment on investment gains and losses. But you also have to keep in mind there are assumption changes. Graham referred to the fact that we will be revisiting all the assumptions with the experience study this coming year and recommending new assumptions where needed. And so those can affect the UAL. They have not been a large impact over the last 10 years. We don't expect them to be a large impact going forward. But that's something to watch and see where those changes are. I think perhaps the biggest part of the 62 million we're showing here in the increase in the UAL due to assumptions was reductions in the discount rate, right? We've brought it down to 6.75. And so that's been a driver. Liability gains and losses. So those are the the changes in the actuarial liability from year to year. And those have normally been very small. We've seen an uptick, not just in your plan, but in a lot of plans over the last 3 or 4 years in the liability losses, largely due to the period of inflation. So we had the higher COLAs or COLA banks in your cases than expected. It also is translated into higher salary increases than expected. So one of the things when we look at the experience study, before we set the assumption going forward, we'll have to assess, was that a one-time event that we incurred the loss, or is that something we expect to continue in the future and we need to change the assumption? But those liability losses have increased the UAL by about 211 million over the last 10 years. And this chart, and there's a table that gives you the numbers, breaks it out by year. And you can see it's for the gray bars I was just talking about, it is the last 3 years that just kind of stacked up there. And the gold bars are the investment changes. And so you can see the big swing between 2021 and 2022. That's the sort of volatility that we can get. That was an extreme swing, but that is one of the key sources of our volatility and risks. Table 2-1 gives you the individual amounts by year. I wanted to skip ahead here though to our stochastic projections. So Graham gave you that actuarial fantasy. It's one scenario where everything comes out just as we expect. Here, what we've done is we've varied investment returns. We haven't varied salaries or retirement rates or anything like that, but we've varied investment returns and generated random investment returns over 5,000 trials. And then these bars stack up where the resulting employer contribution for the system as a whole would be given each of those investment returns. And so the best returns result in the lowest contributions at the bottom of the graph, and then the worst returns in the contributions at the top. And the black line there is our baseline projection. That's that actuarial fantasy that Graham was projecting. So there are a couple of things I want you to note about this chart. First, in the first 5 years or so, it's pretty symmetrical, right? You could have gains, you could have losses. There's a range of where the returns go. That range is, somewhat significant given where investment returns could go. But it's balanced, and our baseline is right in the middle of that gray bar that is the 40th to 60th percentile. After 5 years, some of those dynamics change. First, I want to explain why our baseline is no longer in the middle. And that's because you get to be 100% funded. And when you're between 100 and 120% funded, the contribution rate doesn't change. It just stays at the normal cost rate. Once you get above 120%, then it can go down further. So there's a whole bunch of scenarios that come out right on that black line there. And so that's why it doesn't end up being in the middle. The other thing to note is once you become 100% funded, the green bars and the red bars are not the same size, right? There's much more potential for increases in contribution rates than there is potential for reduction in contribution rates. So it's that symmetry we had in the first 5 years is no longer there because contribution rates can't go below 0. Does that make sense? And so the next chart is the same analysis, but looking at it in terms of the funded ratio. And here you can see the good goes up instead of down. And so you can reach up to almost 250% funded ratio at the end in really good scenarios. Not projecting that to happen. Uh, but just given the current investment policy and the distribution of returns and randomly generating, you could generate a pretty significant funded ratio. Funded ratios can also go down, but when they go down, we increase contributions. And so that gives you a little bit of a floor to how far down the funded ratio can go. Because we're putting more money in to keep it from going down further. There's no comparable limit on the top because contributions can't go below 0. So that's the plan as a whole. One of the drivers to the sensitivity to those, Graham talked about the maturity, and he used the measure of the inactive only funded ratio. I'm going to focus on a different measure of maturity, which is the asset leverage ratio. It's simply the assets divided by the payroll for the system. And before I explain all the numbers on the chart here, let me explain why that's significant. If you had a 10% investment loss compared to your assumption, so you're assuming 6.75, and so we get a minus 3.25% return. That's a 10% investment loss. If your asset leverage ratio is 10, that loss is equivalent to 100% of your payroll. 10 times 10%, 100% of your payroll. If your leverage ratio is 20, that same loss, exact same investment loss, is 200% of your payroll, 10% times 20. When we set contribution rates, we're setting it as a percent of payroll. And so are we having to pay off 200% of payroll or 100% of payroll? For the one with the plan with the leverage ratio of 20, the impact on the contribution rate is going to be twice as much as for the plan that had a leverage ratio of 10. Follow that? Does that make sense? So that's where we see differences in volatility or the different components of your plan and also between different plans. So,
Trustee Vasquez.
yeah.
Yeah. This question is actually for our administrator, Administrator Wickham. Should we have a decline of 10% or more in the markets per se? Do we have sufficient, given these ratios and the leverages, do we have enough liquidity to cover?
Yes, 80% of your portfolio is liquid. 80%. You only have 20% in private markets where real estate, private equity, opportunistic. So the portfolio, this your investment consultant talks about this a lot. Portfolio is very liquid.
Thank you.
So on this chart, the bars are the range from the 5th to 95th percentile of these leverage ratios for national public plans. So there's like 230 national public plans that are surveyed, and we're just ranking them. And so the 90% of them are falling within those bars. The gold diamond is Marin Sarah as a whole. And so you can see you're above the median. The median here nationally is just above 5, and you're right around 10. So the plan as a whole is much more sensitive to these investment returns than plans nationally. Now, I would say in California, the median's between 7 and 8. So it's much, you're much closer to the median in California. But the red triangle that's just below or on the gold diamond, that's the county. And then the square, the purple square is Novato, and the green circle is San Rafael. And so you can see Novato is up at that 20 compared to the plan as a whole as 10. So when we see investment return changes, we're going to expect to see Novato's rate change twice as much, both positive or negatively, as the counties. And we've seen that historically, and San Rafael comes in the middle. And so that's just something to keep in mind as you're going forward and looking at these things, and especially looking at the range of potential outcomes, that it's going to be a different range for the county than for Novato and San Rafael. Novato and San Rafael will have increasingly wide ranges in comparison.
Bill, just a comment then, if I'm hearing you correctly, it sounds like in general, our asset leverage ratio is a little higher than state averages and quite a bit higher than national averages. And so the board should retain a relatively conservative approach to our forecasting and our market rate returns due to that leverage exposure.
What you conclude from it is a policy decision to consider, but understanding that you are going to be more sensitive, whether that how that affects decisions in terms of the smoothing methods we use to control contribution rates, the risk that you take in your investment portfolio. Those are all things to bring into a broader discussion, not just based on this single measure, but this measure should be a part of that consideration.
Thank you.
I also want to add back to Trustee Vasquez's question that portfolio is very liquid. If there's market events like 2008 and 2009, though, getting your liquidity out can still be challenged.
I was going to say, and then
Right.
you're selling the assets you
Correct.
you really
So
don't want to be selling.
the portfolio is liquid, to answer the question directly, but that does not mean that market conditions could make that liquidity very difficult to get to or costly to get to.
Thank you, Jeff.
Okay, I think that was all I wanted to cover in terms of the risks to your plan. You're obviously in a very good situation with your funded status compared to other systems, as Graham went through. So I don't want to be alarmist in putting the risks out there at all. You're in a very good and stable situation. We have policies to manage the volatility, but wanted you to understand the potential ranges of contributions and then a little bit about how those fluctuate. So.
Thank you. This is an action item, so we're being asked to adopt this actual valuation report as of June 30th, 2025.
And the contribution rates that begin on page 130 of the report that will be in effect as of July 1, 2026. So it's a two-part motion, the report and the contribution rates.
Should we take a look at these contribution rates in order to
Graham can address that.
Yeah.
The contribution rates for your classic members do not change because you didn't change assumptions. The only contribution rates, these are the employee contribution rates. The only contribution rates that changed are for the PEPRA members.
Yeah, so I'm going to address that really quickly. So as Jeff said, we do recalculate the PEPRA member rates every year in addition to the employer rates because they are set to be 1/2 of the normal cost for the benefits they are earning. And the benefits that are being earned depend on the population. So to the extent that if you have changes in that population, it can change the normal cost rates, even if you're not making any changes in assumptions. However, your PEPRA populations are pretty large at this point, which means they're pretty stable, right? It means a single year hiring new PEPRA employees doesn't tend to change the overall demographics. And the most important things that drive the normal cost for the overall demographics are the age at which people are hired, not necessarily their current age, but what the age they are when they're hired, and the gender distribution, other things like that. If you look at this chart, this is showing those PEPRA rates. The third column total, that's this year's recommended rates. Those are the rates that'll go into effect July 1, 2026. The rates from last year, the fiscal year that we're in currently, Those are on that right-hand column. You can see that they're not changing very much. Pepra 4% miscellaneous. We do see a bump in that rate by about 20 basis points. That is the smallest group though, right? Because that I believe is only the people in South Marin Fire. Do I have that right? I believe.
Correct.
For their safety employees. The other groups are all pretty stable because those groups are, again, fairly large at this point. Any questions? So this is the other member rates, as Jeff said, are not changing. So these are the only member rates that are changing, along with all of the employer rates that are shown in other tables in this report.
The Silverstein will move to adopt the report and the contribution rates.
Second, Cooper.
Any discussion?
Roll call. Thank you. Trustee Cooper? Yes. Trustee Helway?
Yes.
Trustee Martinovich?
Yes.
Trustee Poole?
Yes.
Trustee Robbie?
Yes.
Trustee Silverstein?
Yes.
Trustee Vasquez?
Yes.
Trustee Vila is absent. Trustee Jones?
Yes.
Trustee Werby?
Yes.
Chair, the motion to adopt the June 30th, 2026 actuarial evaluation and the corresponding employer and member contribution rates passes unanimously 9-0. Trustee Jones voting for Trustee Vila.
Then I guess we should jump to item D, which is our disability consent agenda item.
You can, but remember that you can start later on that item. You can't start earlier than 9:30, but if you want to go to that and then have the actuary come back, that's the
We
pleasure.
have,
of
we
the
have
chair.
some waiting for.
Okay,
so I thought
great.
It makes sense. Has everyone had a chance to read the information in the packet?
And so just from the staff perspective on this, the staff is recommending that the board grant the service-connected disability retirement to Jeff Lemelin with an effective date of March 29th, 2025.
And this is a consent agenda item, so there isn't any discussion. We just look for a motion and a second, and we take a vote.
Silverstein will move to adopt the staff's recommendation.
Second by Vasquez.
Mr. Administrator, would you take the vote?
Trustee Cooper? What agency is it?
Wait.
Novato.
Oh. Correct. So it is Novato Ira. Thank you, Trustee Cooper. So Trustee Healy will be voting for Trustee Cooper because it is fire. That Mr. Lemelin works for Novato Fire. So let's start with Trustee Helwey,
Yes.
Trustee Martinovich,
Yes.
Trustee Poole,
Yes.
Trustee Robbie,
Yes.
Trustee Silverstein,
Yes.
Trustee Vasquez,
Yes.
Trustee Werby,
Yes.
Trustee Healy,
Yes.
Trustee Jones.
Yes.
Chair the motion to grant the service-connected disability retirement for Jeff Lemelin with an effective date of March 29th, 2029 passes unanimously. 2025 passes unanimously 9-0 with Trustee Jones voting for Trustee Vila, Trustee Healy voting for Trustee Cooper.
Good. Then moving back to the cost of living adjustment.
So before Graham talks about the technical aspect of this, I just want to remind the board, and this is in my memo, that you are not granting a cost of living adjustment today. Costing of living adjustment is already included in the benefit tiers that have been negotiated between the employer and the employee. What you are doing today is affirming the actuary's calculation of whether or not there is a cost of living adjustment that will be applied this year. So that's the action, is to affirm the calculation that the actuary will be presented to you today.
Thank you. As Jeff said, we are here to show the calculations of the changes in the CPI and how that affects the COLA. So every year we look at the annual average Bay Area CPI that's published by the BLS. There was one interesting thing that happened this year in that there were usually Bay Area has 6 bi-monthly COLAs published or CPIs published. This year we only had 5 because of the government shutdown. But You rely on the annual average that's published by the BLS. That number increased by 2.18% year over year. We round that to the nearest 0.5%, so that gets rounded down to 2%. That's the increase in inflation that gets used to calculate the COLAs. Each group, there's different bargaining groups that have different COLA maximums. So we have groups that have a 2% maximum, a 3% maximum, or a 4% maximum COLA. That's based on negotiations between the employer and the bargaining groups. Most of your employees are now in that 2% maximum group. Because their maximum is 2% and the CPI increase was 2%, they're just getting a 2% increase in their COLA. There's nothing that happens in terms of their COLA banks. You do have some members that are in the 3% cap group that they had accumulated a bank in prior years. And what that means is inflation had grown faster than the COLA that they received, right? So if inflation is 4% and you have a 3% maximum COLA, you will get a 3% COLA increase, but you will also get a 1% increase in your bank that can be used in future years. So for instance, this year, those groups that had a bank that were getting a 3% maximum, instead of getting a 2% increase, they get a 3% increase, and that bank then gets drawn down by 1%. What's interesting this year is that because the 3% COLA capped groups still had a remaining bank, but the 4% maximum groups, by and large, did not, unless you retired before 1976. The 3% groups that had a bank are getting a larger COLA increase than the 4%. That's kind of unusual, right? But that's happening this year because in the past, the 4% groups have been able to draw down their banks, or they didn't accumulate as much of a bank, whereas the 3% groups still did. So our tables, our exhibits show what the banks are depending on your year of retirement for each of the groups and what the COLA increases are. I will say one other thing in that there are a number of 1937 Act systems that use the Bay Area CPI. Some of them use the December over December calculation. So they look at what was the CPI in December divided by what was the CPI the prior December. Some groups use the annual average published by the BLS. What I think is important is that you remain consistent from year to year, right? Because in the long run, those things will balance out. But this year, you may hear that there are other groups that are getting a larger COLA than 2%, even though they're using the same Bay Area COLA, but that is because those groups were using the December over December average. You're using the annual over the annual. Last year, yours was higher than theirs. This year, theirs is higher than yours. Okay? But over the long run, they should, roughly balance out. There may be some differences, slight differences due to rounding and how those increases play out year over year. But in the long run, they should be roughly equivalent. Any questions?
Offhand, how does the Bay Area CPI compare to, say, the national?
That is, so the CPI for the US, same measure, CPI-U, went up by 2.61% year over year. So this is 1 year where the Bay Area inflation, at least in terms of the published indexes, that inflation grew slower than the overall US.
Major driver of that.
Could be a lot of things. A lot of times it's housing, because housing makes up a very large share.
Housing nationally went higher than it did in the Bay Area.
Yeah, now it's not just home prices,
No,
right?
Right. Yeah, I know.
Rent
I know about those
equivalent,
things,
and there can be lags in these things. But that is one of the drivers of growth.
So if that's the case, we can expect that to flip it.
I have seen some articles seeing that the Bay Area rent prices have gone up fastest in the nation recently. So,
And also people often confuse level for rate of change, which
Right.
CPI is rate of
Right.
change, not the level.
we're higher to
We
begin.
could be higher, but
Yeah.
at a slower rate of change.
Who sets the cap of 2, 3, and 4%? It's negotiated through the employer or the cap? So once again, back to my original comment, is that the COLA amounts are already negotiated and in the benefit tiers. They were agreed upon by the employer and their employees. Yes.
So on page 2, where it says breakdown of all retirees, there's 19 people getting a 0% COLA. Why is
I won't defer to.
there was a time where there was no COLA. Okay, and those people had an option to move to a tier where there was a COLA, chose to stay in their benefit tier. And so it is strictly an artifice of those are the individuals who are in a 0 COLA tier. That population will go away.
I thought you were going to ask about the 8 people that retired before 1976.
Good question, by the way. on this, anything else?
It's one of those, we talk about this or it comes up often. This is one of those things we're having 48 benefit tiers, all with different COLAs, makes benefit administration very difficult because we have to remember for those 19 people, we don't plug a COLA in for them.
There must have been an interesting discussion with them at some point. Do you want to be in a COLA tier or not?
That's not an option anymore.
Oh,
No,
at the
that was
time-
something back in the 70s.
But at the time, it must have been. Anyway,
Yes.
Anyway, this is an action item.
Chair, I have a
Yes.
question.
Yes, trustee.
Mr. William, can you explain a little bit? So what we're seeing here at the call, you just mentioned that the actual call has been set with employers and employees. So what we're seeing here and what we're voting on, can you explain this again? And is this about paying COLAs to the retiree? What exactly is this here?
Yes, so this is not about active employees. This is the law provides that retirees can have a cost of living adjustment. The employer has to adopt it and it has to be included in their benefit tier. And the COLA is applied on April 1st of every year if there is one. So these are all amounts that are included in the benefit tiers that were once again adopted by the employee and the employer and are provided to the retirees subsequent to the actuary's calculation.
So we're simply affirming.
Up to a capped amount, and the capped amounts are either 2%, 3%, or 4%.
So we simply now by this action is affirming.
What you're doing is you are affirming the actuary's calculation of those amounts.
Or the calculation of those amounts.
Yes.
Okay, got it. Thank you very much.
And if
Yeah,
you
we'll
want, we
figure it
actually
out.
put the data, we actually put the BLS page in there. So if you want to check our numbers, please.
Okay, Silverstein will move to approve the calculations as done by the actuary.
Second by Helwig.
Any discussion? Mr. Administrator, take the vote.
Trustee Cooper?
Yes.
Trustee Helway?
Yes.
Trustee Martinovich?
Yes.
Trustee Poole?
Yes.
Trustee Robbie?
Yes.
Trustee Silverstein?
Yes.
Trustee Vasquez?
Yes.
Trustee Vila's absent. Trustee Jones?
Yes.
Trustee Werby?
Yes.
Mr. Chair, the motion to adopt the calculation of the actuaries for the April 1st COLA passes unanimously 9-0. Trustee Jones voting for Trustee Vila.
Thank you very much. Good to see you all.
Thank you.
Thanks. Do you want to talk about future presentation?
Yeah.
Well, let me set this up. So one of the things you've heard a lot about today, you heard during Bill's thing, is about what happens when you get to 100% funded.
Yeah.
Right? And how there are different things that concur. Graham shared with me a presentation that they had done with another SERL system on this topic. And I think it would be valuable for you to see this because there may be some policy implications that you want to consider when you get to that point. And you are very close. And your return so far has been very positive this year to date. So
We have been there before.
Right.
did.
No, I don't want to jinx it, but I think that since we're not there, but we could be, I think that this is the time to have that discussion so that if there are policy things you want to consider, you do that before we get there.
Yeah.
So with that.
So that's a great summary. And I think it's actually City of San Jose. So it's not a SERL system, but similar characteristics. When we looked at this back in 2021, and everyone was surprised, we jumped over that 100% threshold. The board made a policy decision really to stick with their policies, which ended up being wise because we were not at 100% for very long, right? So we considered some things that would have changed the contribution rates drastically, but we would have just seen them bounce back up the next year. So we're not saying that you're necessarily going to make a huge change in your policy, but as you get closer to 100% funded and exceed that, there are things that you want to take into consideration, as we discussed. You have a plan that is fairly mature, right? So we can see these large swings in contribution rates. You have levers that you can control, not just in terms of your investment policy and your assumptions, but how you amortize unfunded liabilities, whether you set something called a contingency reserve. And we can talk about how some of those decisions might reduce risk going forward, especially as you get or exceed 100% funded. And there's just as Bill pointed out, there's a bit of an asymmetry, right? There's only so far you can reduce the employer rates. They can't go below zero, and they can't go below the normal cost unless you get way overfunded. But the rates can go a lot higher, right? So we will have some discussions about trade-offs in terms of cost benefit, risks and reward. And we think it's a good time to do that as you're getting closer to 100% funded. There are also some administrative things that might simplify some of the valuation procedures. One thing we did when that hot moment when we were over 100% funded was we did equalize the funded ratio for some of the smaller employers, right? And that did have did simplify some things. There are some similar decisions we could talk about in terms of how you're allocating costs between these employers once you get above 100% funded. So we look forward to having those discussions, and I believe we're going to schedule that with the
I'm
spring
going to be
workshop.
recommending to the ad hoc committee, which meets later on, that this be one of the topics. Because I also think Graham mentioned this, that there is an investment component of this discussion.
Gonna say.
Yes. And so it would be good to have your consultant here as they're going through that. They'll be familiar with what that's happening, but anything Graham puts together, they can share with the consultant
I mean,
also.
if we were to de-risk the thing, that you would reduce your expected return, and that would solve your problem as far as being overfunded pretty quickly.
It could, but then also increases costs for your employers if you reduce the thing. So those are the kinds of things that we want to talk about when we're not pressed to do it.
Right.
Thank you very much.
Thank you, Grant.
Then moving to the administrator's report.
Good morning, Mr. Chair, members of the board. Just a few items to report. I mentioned one, the Ad Hoc Education Committee, which our trustees, Robbie, Poole, and Silverstein will be meeting after this meeting to work on the draft agenda for the workshop. I mentioned this last meeting, but I want to just make sure it gets on your radar that we are doing a cyber training with our cybersecurity vendor, Linea Secure, at next month's board meeting. All right. And also just a reminder that next month's board meeting is a bit of an oddity because of the Calipers General Assembly. It is Thursday the 12th, not Wednesday the 11th. Right. So make sure that you've got that on your calendars. We'll send out a reminder. Okay, because the Calipers GA is March 8th through the 11th, which is normally our board meeting on the 11th. So the March board meeting is on Thursday, the 12th. That's my administrator update. Staffing update. We still have the one vacant position. It's on hold for recruitment. Facility use, the Parks and Open Space Measure A committee did use our boardroom for a recent meeting. You may have read that the County Board of Supervisors board chamber is being reconfigured with new audiovisual. So that means that's not available. They've moved board meetings over to the Marin Center. There are some of the smaller commissions that were using the meetings that are seeking meeting space. So I'm trying to be flexible with letting them use our space where it's appropriate. Future meetings, I already mentioned that the March meeting is on Thursday, the 12th. We have an investment committee meeting on the 18th of March, and then finance and risk meets on March 25th. That is my administrator.
Mr. Wickman, when you say workshop, what do you refer to? The workshop?
So the board has what we refer to as a strategic workshop. It is not it is a board meeting because the board is meeting, but it's not something where we're doing the routine things that we do in this meeting or what you do in the investment committee meeting. It's a day where you bring in topics that you know are not typically discussing with an educational bent for them.
Is it scheduled?
Yes, it is scheduled right now. It should be in the calendar that you have for May.
Thank you.
May 20th.
There are two of such meetings.
Yes,
here.
correct. There's
So
one in the spring and then one in the fall in October.
believe the October one's the 27th. but-
Yes.
Okay. That moves us to trustee comments. I see that there was a CalPERS Administrators Roundtable.
There was. The CalPERS administrators got together last Friday and had a couple of topics. You can see what those are. One was about do any of the systems provide access to their automated pension administration systems to their trustees. As I'm sure you're not surprised, nobody does. Some people have created other separate types of dashboards and other things for people to get information, but not having access to the actual benefit system. The biggest discussion was Senate Bill 827, which went into effect on January 1st. This was not on the radar of the Sackers Ledge Committee. They actually had looked at the bill, but it originally did not believe the bill applied to us, but the bill does apply to us. So 827 creates a new 2-hour education requirement for public boards. And the requirement is really around things like budget, finance, bonding. It tends to be very focused on municipalities who do these types of things, like would issue a bond or are doing budgeting. And so it does apply to us because it amends the same section of the law that created your ethics requirement. So we are going to need to comply with this, and the administrators talked about how we are going to do that. I've talked to the director of finance because I believe they're going to have to educate the county on the same sorts of things to see whether we can piggyback on that. I think the best suggestion that I heard that most people agreed is we may try to engage somebody to provide this type of training at a Sackers or CalPERS GA the way we do today, so you could get your 2 hours at that. Not all of it applies, not all of the new legislation applies to you. Once again, there's a whole section that says you need to provide training on bonding, but you're not an agency that issues bonds, so that's not applicable. So we need to work through which portions of this 827 apply. But the bottom line is there's additional education we got to.
Is it additive to the 24 hours? So it's now 26, or is it?
It's not 26. It's just an additional 2. Like your ethics has to be 2 hours.
But
You
it's
now
like a
have
component of the,
yes,
of the.
yeah, absolutely. You now have basically think of you've got AB 1, 2, 3, 4 ethics, and now you've got SB 827 finance.
Is it, and if there's a possibility for an online option now.
Looking at that too, because I've talked to council about this, we've heard there might be some work being done by CSAC, which is the Association of Counties, and maybe they're doing something. So we will look for alternatives for you. But I think the most important thing that we were trying to make we, the administrators, is this applies to us. We have to figure out how we're going to provide this education.
Jeff, I know we're not an agency such as a municipality that gets to offer bonds in the municipal bond market, but are we not backstopped by a bond from the county?
Not backstopped. The county took out a pension obligation bond back in 2002, and they gave you the proceeds to that bond. They are paying the bond.
Got it. Through our tax.
It is not on our books. It is
It's
on
not
their books.
on their books. Got it. Is that roughly the terms of that bond? 30-year, 20-year bond? And do you know how are we doing on that bond? Yes, you can.
Debt service payments will continue for another 2 years or so. So I think we'll be done paying off
Oh, is
that
that right?
bond. I want to
Great.
say 27 or 28. I believe it was a 25-year, it's a 2003
Okay.
bond
Issue.
issuance. And so we're already discussing at the county level how to complete that debt service moving forward.
Got it.
And then where those debt service payments that were previously pledged to this bond will be reappropriated to other county.
Thank you.
Then the other thing, a couple of items from the roundtable. We talked about the new requirements for trustees to file directly with the FPPC because you are considered public officials with public investments. So everybody is complying with that. And that was the administrator roundtable.
I see there was an attorney's roundtable to,
There was an attorney's roundtable. Good morning, members of the board, and I attended that. Thank you for sending me. The first topic was, is listed here, coordinating litigation with outside counsel. The presentation covered that topic as well as an AI topic. It's called AI Made Me Do It. What could possibly go wrong? That was a very interesting discussion about AI and understanding risks and the way in which policy development has evolved over the last couple of years in that area. The second topic was on PASS upgrade projects, so pension administration system upgrade projects, and the evolution of those, risk factors, attributes that appear to be important at the front end as you're negotiating those. The third topic was investment transactions for non-investment attorneys. This was a presentation that had been provided to the attorneys at the attorney breakout at Sackers by the same presenter, and it was a nice presentation. I then informed the group about a decision that we obtained on behalf of the Ventura County Employees Retirement Association relating to a reciprocity related topic. It's super technical, but thankfully the Superior Court understood and agreed with the way that VSERA applied the law. And so we walked through that. The leader of the session was Manuel Serpa, who's the general counsel at OSERS, and he had a series of topics that he then laid out for us to discuss. And those are all listed here. And so we just discussed different aspects of how the retirement systems engage with employers on retiree return to work related issues, how systems address a circumstance of a member who's established reciprocity, then doing something that breaks reciprocity and the consequences of that. And there are a variation of approaches to that topic. There have been some systems who've dealt with some pretty substantial either meeting disruptions or concerns about meeting disruptions and how they've sort of proactively assisted their board chairs in particular in managing that situation. And then a pretty robust discussion on the importance of people understanding attorney-client privilege such that it's preserved. And that's it.
were there any other, the trustees attend any other educational things that they would like to tell us about? Are there any other comments from trustees? Okay, then moving along to the amendment to the investment consultant contract.
Okay, just as a little refresher, back in 2024, we issued a RFP for investment consulting services. The result of that RFP was a recommendation to the board back in July of 24 to hire Callan as your consultant. So they were the successful bidder to that process. You approved the agreement with Callan, which include a specification of items that we would pay for, a base rate, and then additional items. One of the items that was not anticipated in that is adding a consulting on private credit, which you have now made a permanent allocation to private credit. As a reminder, when we did the opportunistic non-allocation, because remember, you have a zero target to opportunistic. So when we hired the opportunistic managers back in 2020, Callan did charge a fee for that work. They charged a one-time fee because the program was not anticipated to be ongoing. So there was $85,000 that was charged that we paid for the work they did on the three opportunistic managers back in 2020. They have now basically said that in order for them to do the work for your permanent private credit allocation, which is just like your private equity is pacing plans, manager searches, because as you saw last time, you'll have more than just a couple of managers. You'll be if you continue with the program, you'll be adding managers. The evergreen fund structure means, once again, it's more of a constant process with a dedicated allocation. So they have said that the cost to provide those services on an annual basis is an additional $95,000 on top of the fee that we're currently paying today. So I have provided you with my memo about this and also the details of the agreement, which includes the year-by-year fee chart. We are in year 2 of the fees. Okay, so year 1 has already gone by and we're in year 2. So it is an increase of 95,000 onto that year 2 amount. So based on the board's desire to want to move into this asset class and the work required, recommending that you give approval for the administrator to sign the agreement with Callan for the amendment.
I have a question. Can you go back and just explain again why opportunistic was a one-time fee, whereas private credit is ongoing?
So when you created the opportunistic, you said, we're going to do this it. And when we're going to hire 3 managers, and when they're done, they're done. There's nothing else that's going to happen with that. That's going to go away. And that's still the way your opportunistic is going to do. That's why you set it up as a 0 target. But you've now said we're going to have a permanent 5% allocation. And we're going to hire programs that are going to go on forever. They're not going to have fixed termination dates of them. They're going to be evergreen funds. So that means you're going to have an ongoing forever allocation to it, and the manager review pacing and everything that goes with that, as opposed to you did it one time and you knew that it would be done in roughly 8 to 10 years.
Thank you for rehashing that for me. Thank you.
Not a problem.
So, Jeff, does that mean the opportunistic is like set with one manager forever? I'm still not clear.
No, you will wind down your opportunistic program. So AB Carval, Fortress, and Varde, those will go to 0. And that will be it. You're not reallocating to those. You're going in a different direction to a permanent allocation to credit.
And what was the time on that? Like for how long they were?
The opportunistic?
Yes.
Yeah, once again, it's really designed around what the ramp up and ramp down, and the ramp up, as Callan said at the last committee, was slower than anticipated, right? Because although the time you created the allocation in 2020, there was a belief that there were going to be dislocations that really allowed for investment opportunities that did not play out immediately. So a couple of the managers did not fund those things as fast as you expected. At the time, I believe what Callan projected was that it would be a 7 to 10 year period of those. Still may be the case, but you will wind those down to 0.
Okay, thank you.
So if I understand it, we're discussing, we had a one-time cost from Callan for this opportunistic, and now they're trying to change it to an annual fee for a new allocation. So that's 5%.
They're not trying to change it. They're saying that you created a new allocation that's going to be an ongoing allocation. That's going to have an ongoing cost for us to do that on a regular basis.
I'd like to make a motion to approve the additional 95% annual fee.
Not 95, 95.
No, I'm sorry, $95,000 annual fee to the existing contract.
Silverstein will second.
Any discussion? I have a question.
Yes.
Are they telling us that when we make our initial allocation, we're going to allocate some number, and it's going to be the same thing like it was before? There's going to be a ramp up. There's going to be we're going to do this thing. So
right.
I'm not quite clear on why there's an annual fee, because it's not like they're going to do the same work the next year.
Every year, they're going to present you with a pacing plan for this program. And the pacing plan will say we don't need to allocate, or we may need to allocate. And all of that will be driven by market conditions of your initial allocation. So
isn't that a lot different than the initial work where you're identifying these managers and you're
understood, but you remember, you're not just going to be reallocating to existing managers like you have been doing with private equity. You're going to be bringing in different funds with those pacing plans.
But the first time we do it, we're going to be putting in, you know, a significant amount of money to fill this.
Yeah, you're gonna
allocation.
well, the first time you haven't gotten here yet. They're going to have to present you with a pacing plan for the first time. What will the pacing plan look? So how much do you have to put? So yes, more than likely, the pacing plan they present for the initial allocation will show a significant to try to get up to the target, but it will be a plan to get for how you get there. And then we'll revisit that plan every year and have to make new recommendations.
Jeff, would it be fair to assume that likely they're going to spend actually more time in the first year getting us set up and in place, and going forward, maybe less, but what they're proposing is to smooth out that expense over the life of their contract?
They are, because this dollar amount is not indexed to an increase in inflation the way their base fee is. So this 95 is not going to increase each year, as opposed to their base part, which they have proposed to increase based on cost of living. So yes, there will be more cost upfront for that, and likely less cost, but you'll still have pacing, monitoring, and other activities that go with it.
But I'll just remind Trustee Robbie that they did the entire thing for $80,000 last time. For
$85,000.
But that was a different thing, so
It was pretty much the same thing.
yeah, I'm not sure about that, but
Yeah.
no further questions for me.
I'll just point out that the contract with Callan is 5 years.
Correct.
Right, and so at the end of 5 years, we can just dump Callan completely, get another consultant, or we can renegotiate the fees that we have. We choose to continue with them. So,
I have a question.
Is it safe to say that when the contract was negotiated, was structured initially, was based on the number of areas of our investments, or because you're talking about baseline, and then now we added an area where they want to charge more. Were they assuming that we're not going to do that?
The contract was based on them providing consulting services for the asset classes that you had.
Okay, so as is.
So
At
it
that
did
time.
not anticipate that you would have private credit.
Jeff, I have a question. I'm under the impression that for this program, every year, quoting you just now, they will be bringing in new sets of investment managers for private credit. And does that mean that the holding period with which we deploy capital into these managers will potentially change on a year-by-year basis?
I don't know if I know enough. That's a very good question, Trustee Vasquez, and I think it's a question you would need to ask Callan. But I'm going back to, if you recall, the last, and I know this has been a couple months ago now, but the last private credit where we decided Evergreen. Remember that discussion? And then manager Callan showed you. So that's not just going to be 2 managers forever.
Yeah.
That's 2 managers, and then 2 more managers, and then 2 more managers, depending on pacing. So
Yeah.
and that was a concern that I have, is exponentially adding those managers and what goes into that.
Right.
But that is how that Evergreen program would work. So it does mean there will be more work for them as their pacing plan proposes additional investments to fund the program.
Yeah, that brings in a lot additional investment costs, not just the ones that are declared here. Callan does have a business unit that conducts research for these managers across all their asset classes. So I'm just concerned about we don't churn portfolios here. Even we don't churn public managers, and I don't, even though the Evergreen structure, as you described, is one that brings in 2 or 3 managers as appropriate. As you know, and I believe this body knows, on several occasions, my overall concern has been costs. I think we have a duty to bring down costs for our members as well, despite the performance and the excellent results. So I do have some concerns about the evergreen structures incurring additional costs, whether explicit or implicit.
Well, I think we will make those decisions as we go forward and we hear the reports and so on. So, you know, we have decided to invest in this kind of category, that kind of category, and have consultants to help us, and we'll see what's presented to us and make our decisions, and we may continue with this or not continue with this.
Yeah, and
That's all part of our overall asset allocation and so on. So
and I agree with that. If you change the program, then we would go back to Callan and discuss the cost should change also with that. You know, so if there's a move, do a different type of structure, then there should be there will be a discussion about any costs that were
so for example, we've decided to not invest in commodities. And Callan was providing consulting services for us on commodities. We could go back to Callan and say, you know, maybe you should reduce your fee because we're no longer interested in commodities there. So I think these are discussions to be held with Callan as we move forward. Their contract ends in a few years here, and we'll see how it goes there.
In thinking about that, is there any thought or any use to doing it, making it a one-year deal for now and seeing how it goes, and decide making a decision about whether we want to do that again next year? Why are we committing ourselves to 4 more years?
So there's nothing wrong with that. I can certainly go back. I think what that implicates is the question that Callan's operating and that you set the program up to be evergreen. So if it's not evergreen now, then what is it? How does it work? So I think that would mean that you would need to discuss that with Callan as part of an investment committee discussion. That's all. I'm not advocating for or against. I'm just saying that if I go back and say, so we're willing to pay this as you've ramped the program, they're going to say, wait a second, it's an evergreen program. What happens in the future?
I think it's wise and prudent, since we've never executed an evergreen program. These are all fairly new vehicles in the marketplace that a one-year trial period, if you will. It's a sensible approach. And in the spirit of Trustee Silverstein's comments, if it goes well, hey, let's re-up. If it doesn't, then, we haven't fully committed to a longer term cost.
Well, we made this decision to go with private credit and change our asset allocation, if you will, after an analysis that showed us that our expected return overall was going to be a little bit better doing this. So we made this change in the expectation that our returns are going to be higher. There is some cost to doing that. I think we should proceed with what we sort of decided to do. There is a cost. There is an expected benefit that I think is going to outweigh the cost here, and we will see, and we'll see what we think in a few years. Of course, we're not going to know the results, in the first 60 days, 90 days, first year or two. So let's just proceed. Yes, there is a cost that has come up here, and then and we'll see, of course, and we'll continue to see how Callan performs and their overall fees are worth it or not. So we're not locked into anything with them forever here. So in fact, we have done searches for other managers over time, and those will continue.
I have a follow-up. How did we, we decided we asked Callan, and we allocated to private credits without even talking about the cost. Is this a normal practice, Mr. Wickman, that they do that and then they present their fees, or weren't they concerned about the board not approving the extras? How does it work usually?
So it's not an unusual process that this happens, because once again, Callan's fee for doing this is typically not significant in terms of what you're seeking to try to get for your portfolio. If there's a fault here, I was aware there would be a fee. I probably could have notified the board that if you allocate to the program, there'll be an additional cost to that, but that's not unusual that that's what happens. If you create a new asset class, particularly in private markets, which is it's at, there's going to be a cost for that, additional cost for that. So,
Okay.
So
So
I-
it sounds like now we are between either go with 1 year or go with the full proposal, I guess.
well,
at this
I
point.
think that I would want to remind, just in terms of where we're at from a process standpoint, that the motion you have and the second you have is to adopt the agreement. And that's the whole agreement. So there would have to be something to change the motion in the second.
Okay.
To do something different.
Trustee Cooper first, and then Trustee Silvers.
Yeah, I was just gonna say that, Callan is a trusted partner. We just went through the RFP process, chose them. They have an expertise that we rely on. And, I think it feels flaky to go on a year-by-year basis. They're trying to develop a long-term strategy for us and to implement it, throughout. So I don't, I would support the motion, and we always have the ability to changes as if we change course down the road.
And I would just underscore that I think it was obvious to anyone that private markets, private equity, private credit, the investment managers have higher fees. So our fees are going to go up just by allocating to this area. The fees for managing what we had in this category was tips and public real estate, where the managers have very low fees. So we know, or we should have known, that in general, the fees were going to go up, but the returns were going to go up, and we were going to have a more diversified portfolio here. So I think this is a very minor amount in the terms of the overall amount of money here that's involved in the expected returns and the diversity to the portfolio.
I agree with that approach. I think 1 year it's not going to make sense from business side, and also that shows the trust that we put in them. And again, if we pull out in a year or so, we could renegotiate. So I'm inclined to support the motion as is.
Yeah, I just would like to add, I'm definitely sensitive to long-term relationships, particularly, when you have the historical narratives and know where the bodies are buried, if you will, to use a figure of speech. But I must confess, I'm a bit conflicted and torn, because this is a new, for all, I'll just call a spade for all intents and purposes. This is a new business unit within Callan. And there are several firms who do specific private market investment consulting, that if we're going to dedicate a permitted allocation, a search makes a lot of sense from a risk-reward perspective. I understand the upside opportunities for private markets in terms of returns expectations. But I'm always more inclined to side with, with the fiduciary duty for 7,700 members, rather than building out a business unit within Callan. They have a team of 6 people doing this. They're smart people. They're great people. But I do believe that if we're going to have a permanent allocation into private equity and private credit, we should explore a search.
Any other discussion? Mr. Minister, take the call the vote.
Trustee Cooper,
Yes.
trustee Helway,
Yes.
trustee Martinovich,
Yes.
trustee Poole,
Yes.
trustee Robbie,
Yes.
trustee Silverstein,
Yes.
trustee Vasquez,
Abstain.
trustee Jones. Not here. Trustee Healy, you can vote on this.
I would abstain.
Trustee Werby,
Yes.
Mr. Chair, the motion to provide the administrative authority to enter into the contract amendment with Allen passes 7 voting for the motion, nobody voting against the motion, but 2 trustees, Vasquez and Healy abstaining.
Good. Moving on to our favorite subject of the year, the Form 700 refresher.
Do you, Mr. Chair, do you want to take this is a fairly lengthy.
Yeah, why don't we take a 10-minute break? We'll re at 10 of. Good point. Thank you. calling meeting back to order. FAR 700.
Good morning, members of the board. We are here for our annual. We're here for the annual update on the Form 700 and related rules. For some of you, this will be a refresher, and for others, this will be the first time we've gone through this exact presentation, though in all of your new trustee training, we have touched on it. So hopefully this will be familiar territory. Let's see. Do I press a button to move it? Or? What did you do? Oh, now it'll go. Okay, perfect. All right, great. So there have been some changes since we went through this. So I've identified those, most of them in red. There's another one on the Schedule C that I don't think I've put in red, so I'll have to remember to tell you about that one. So we'll pay particular attention to those changes. We always do a review of the gift rules because those are trash for the unwary, potentially, if you don't know that you have to keep track of gifts that are reportable throughout the year that need to be included on your Form 700. And then we will talk about how you get help. Hopefully by now you've all received and thought about the fact that you need to file a Form 700 by April 1st. So this is in the spirit of getting you fully informed to do that. So some first framing of this, why do you have to file the Form 700? It's because the Political Reform Act, which is a statute that applies to public officials such as all of you, as well as your executive staff, requires all of you to file this form. And it's a way in which you disclose to the public, to your fellow trustees, to members of the system, certain aspects of your own personal financial holdings, so that they can assess whether or not there's an issue, so that you and those who assist you can assess whether there's a disclosure situation or a recusal situation with respect to any MCERA business. And because in those situations, you may have to recuse yourself from MCERA decision-making. Oops, sorry, back. So under the Political Reform Act, the Fair Political Practices Commission, known as the FPPC, is the regulatory body. They're the ones who issue the Form 700. They will provide advice letters and issue opinions on matters of law that are asked of them. And they also have an enforcement division. So they will bring enforcement actions from time to time against those who either don't file their forms or file them incorrectly. The FPPC also establishes certain monetary thresholds that result in reporting or other prohibitions on receipt of things like gifts. The reason you all need to file with respect to your work for MCERA is because you are considered public officials who manage investments. That's a defined term under the law. And in addition to you all who are statutory filers, there are individuals who are identified in your conflict of interest code who also have to file. They're called designated filers. The new rule here is to statutory filers, as I believe you all know, is that now you need to file your Form 700 as of this year with the FPPC directly. Previously, you filed with MCERA. MCERA will have a copy, will get a copy, I believe, of the Form 700 that you file with the FPPC, but that is now your filer, where you file. As we go through this, if you have any questions or comments, by all means, please let me know through the chair. The logistics of filing Form 700 are on this slide. First of all, when you first take office, within 30 days, you need to file the form. And then annually thereafter, you file it, usually around April 1st. And then when you leave a position where you're a Form 700 filer, you have to do a leaving office statement. This is a retrospective filing. So when you're filing April 1st, what you're reporting on are your holdings, your assets, transactions, et cetera, that occurred during the year prior. Calendar year prior. But when you're filing the first time or the last time, it's on a rolling basis for the 12 months prior. And one thing that was on that last slide that I didn't note relates to amendments. You can file an amendment anytime. If you realize that something in your prior filing was not correct, you can just simply amend your schedule A, B, C, D, or E, whichever one had the issue. This slide identifies the types of financial interests that need to be disclosed. So first of all, this first category is as important for what it includes as what it excludes. So it's gross income from non-governmental sources. That means for those of you who are government employees or employees of Marin County, for example, that source of income is not considered income definitionally that needs to be reported. However, if you have another job, a weekend job, a night job, or income from other sources that is not governmental, then you do need to disclose that from a union, for example. That's not a governmental source. You have to disclose that. The second category relates to the type of financial interests that's disclosed on separate schedules that we'll walk through of the Form 700. So your investments, any individual stocks or bonds that you own need to be disclosed if the value of them exceeds $2,000 in the prior year. Any positions that you have in business entities, any real estate that you own in Marin County or within a 2-mile radius of Marin County. And then income from sources located in or doing business in Marin County.
Is San Francisco within 2 miles?
I defer to your geography on that. I would think probably it's worth disclosing if it's in San Francisco. New rule on this slide. So it used to be that digital financial assets, so assets in crypto, for example, or crypto assets, were actually excluded from the definition of financial interests. As of January 1st, 2026, that definition has changed and they are now included. And so starting this year, you will need to include within your disclosures, if you have any crypto assets, what those are. And then as noted here, gifts from all sources, and then we'll walk through that much more specifically, but that applies regardless of whether the gift giver lives in San Francisco, in New Mexico, or in Italy. Importantly, financial interests includes not only your own, but also those of a spouse or registered domestic partner and dependent children. The Form 700 is a public record. This is what the cover page of the form looks like. And so you can see here, the agency name here would be MCERA. You're on the Board of Retirement. Your position is a trustee. That auto-populated, in my experience, through the system that MCERA used previously. I'm not sure when you do this with the FPPC, whether it will auto-populate or whether you'll need to re-enter all this information this year. In my experience, myself being a Form 700 filer who also has to file with both MCERA and the FPPC for various different positions, it does auto-populate once you've entered the information the following year. So we'll see, and Jet and the administrator might have an answer on that.
So what you're going to experience is that it will auto-populate with the basic information about your name, your agency, the fact that you're an annual filer. But for the red box, which is all of the schedules, it will ask you to select the schedule that applies to you. So there will be two boxes, one that you select and one that you don't select. And if you don't select one of the schedules, it will remind you before you move on. It will say, you did not select this schedule. We're not going to include this in your disclosure. So it will only give you the schedules to fill out that you say you need to fill out. But for this first time, my experience was you had to re-enter things. They did not pre-populate what came before. That was what my experience was. Maybe it'll be different for you, but I don't think you should anticipate that.
The chair, through the chair. Sorry, trustee.
With those investments, it's individual stocks or actual like Bitcoin, not ETFs, mutual funds that in those areas.
So the rule on ETFs is if it's a well-diversified ETF, it's treated the same way as a mutual fund and it does not need to be disclosed. But if the ETF is, say, a crypto ETF, then that may need to be disclosed. You should look at the reference pamphlet for more information because they do provide examples.
Let's let you.
Yeah. Okay, and actually, I should probably give my caveat here that we're not giving individual legal advice to individual trustees on how you fill these out correctly. What the administrator and I attempt to do as appropriate is provide sufficient guidelines so that you can know where to go for information, assist with answering basic questions. But we're not individual lawyer. I'm not an individual lawyer on
For
this.
the purpose of this presentation,
Yeah.
why don't you just ask Ms. Dunning there for recognition for the question rather than going through.
Okay. Thank you. Yes.
I see notice the new changes now with digital assets and, the marketplace is what it is. It's always changing with new vehicles, new instruments and such. But generally speaking, if any trustee has an interest, say, in now private market fund, whether it's a private equity fund or a private credit fund, as they're getting more and more prominent, are those instruments and vehicles now part of the disclosure process as well?
Typically, yes.
So
Absolutely. And so that does lead, and we've seen situations at different boards where because of that, members of your board will have to step out of the room when something's being considered.
Got
But
it.
yeah,
And
so absolutely.
Got it.
Yeah. All right, so now we're moving on to Schedule A1, and this is the one where those types of investments would be disclosed, and you can see the information that's required. It's both detailed in the sense that each of the specific stocks, if you own individual stocks, need to be disclosed, but it's not detailed in the sense that the categories provided for the fair market value are pretty broad. You have the 2,000 to 10,000, and then you jump from 10,000 to 100,000, 100,000 to a million, or over a million. So you check the correct box, you identify the nature of the investment or partnership, to the point. If any income was received, you identify that during the reporting period. And then also if you purchased or disposed of the investment during the disclosure period, that also has to be identified. Note that if you own these assets in an IRA or a 401k, they still need to be disclosed. We've identified here certain non-reportable items. I didn't say ETF specifically, but as I noted, the diversified mutual fund rule applies to ETFs so long as those are sufficiently well diversified.
Ashley?
Yeah.
This may be just personal, but if you have an interest in a partnership that sells a property, but you still own the partner, you still own the interest in the partnership, but its value's gone down, how do you handle that?
Well, first of all, if you have really technical questions, I would call the FPPC. My understanding is that what you're reporting is the value of the partnership, and what my inclination to do would be to check the box that's the highest value of that partnership during the reporting period. So an easier example would be a value of a stock. It might be under 2,000 during the reporting period, but go up to 100 to over 2,000 during that period as well, and then go down. I wouldn't just use the December 31st. So for that partnership, right, you said the value
Again,
went
the
down.
reporting period is anytime during the period. not at the end, not
2025.
At the end.
That's correct.
Right.
Yeah. And so here, the type of financial interest, Chair Werby, that you're describing might be one that applies for this A2, where you own 10% or more in the investment, in this case, in your case, the partnership. And so this is where you disclose that.
So if you own less than 10%, you don't need to disclose.
No, it's an A1.
A1, it would be A1.
Oh.
A1 disclosure if you own less than 10%. If you own, this is a special disclosure if you own 10% or more, or you and your spouse or registered domestic partner or dependent children own that. And Schedule B is interest in real property, including any rental income that you may have. Real property does not include your home unless your home, unless you get a tax report. You use your home also for business purposes and take a tax deduction, in which case you do need to report that portion of the value of your home. Also, real property is limited to the jurisdiction of MSERA and 2 miles within the jurisdiction. That said, there are people from previously on this board and elsewhere who will just simply report real property that they own elsewhere, and just over disclosure can't hurt you. All right, so this slide repeats or states what I just stated verbally. Schedule C is where you report income from non-governmental sources, loans, and business positions. A couple of points here. One is that there's a new requirement, and this is where I did not remember to identify it in red, and I'm not seeing it right here, but I know that there is a new law that says that you have to report any prospective employment that you've negotiated for the upcoming year. So if you, for example, are in the midst of negotiating a position to be hired at X company, and you've reached a certain level of agreement about that, though you haven't yet been employed by them, you have to disclose that on your Form 700. It's a way to provide transparency around something that would be illegal if you were engaging in business on behalf of MSERA, but you were also in the process of getting a job from that company. That would be a violation of California law. Also here to note, if you are on the board of a, say a corporation, and even if you don't get compensation for it, you have to disclose you're on that board. So this provides some basics around Schedule C. Note that the threshold for disclosure on this schedule is less than the threshold for disclosure for investment. So it's compensation of $500 or more in the year. Again, you have to report not only your own income, but that of your your spouse or registered domestic partner. Uncompensated nonprofit board positions do not need to be reported as long as they're a 501c3. And I think it may apply to 501c4. If you have a question, though, look again at the pamphlet. Schedule D is where you report gifts other than travel expenses. That's a separate schedule. And so this shows you what needs to be reported. So the source, as we've talked about in these presentations, and I'll go through in the gift portion of this, is the entity. For example, if the source of a gift to you is somebody at a SACRS conference who takes you out to lunch, and that person works for company X, and at another SACRS conference, you go to a lunch with somebody different from that same company X. Well, in this example, 2 SACRS would be 2 different calendar years, but let's assume for the sake of discussion that it's in the same calendar year. Then that would be a single source, and those gifts would need to be aggregated. And if they aggregate to $50 or more, then you have to disclose it. There are 2 gift limits that apply to you. Really important because this question came up to me last week. Not from this system, but you're not allowed to receive gifts from a single source in excess of the gift limit, full stop. That's $630. So if somebody's paying for you and your spouse to do a round of golf somewhere, and that includes the meal, you may well be over the $630 limit, and that's a violation of law. It's actually a misdemeanor. There's also a conflict of interest gift limit that applies on a rolling basis for the prior 12 months that prohibits somebody who received that level of gifts from participating in decision making with respect to that gift giver. This is what I already said about what the amount is and how it applies. And this is the 12-month look back. Oh, so now we get into the gift discussion. The gift rule is stated here, and I put it in quotes and provided the whole thing just so that you can see how comprehensive it is. It's basically anything for which you didn't provide equivalent or greater value. And it can include all sorts of things that are not money, like discounts that are not provided to the general public, tickets to events, plaques with some exceptions, flowers with some exceptions, definitely travel expenses. So if someone's paying for your hotel, you need to be careful about that because that may well be a reportable gift, unless it's MCERA who's paying for it, because that's governmental. So remember, that's exempted. Meals and beverages also are gifts, again, depending upon the source. And then non-reportable campaign contributions. I just talked about this example of multiple gifts from a single source that total $50, and this walks through that as well. There are some important exceptions to the definition of a gift that were put in into the FPPC regulations a number of years ago to provide a little bit of assurance that's based on reason, I think, as to how people live their lives. But remember that those exceptions typically do not apply to those who fall within the little I's. So people who do business with MCERA, who would like to do business with MCERA, who are registered lobbyists, that they do not apply. Those exceptions do not apply. So as you'll hear, one of the big exceptions relates to immediate family members. But if somebody is giving a gift to your family member, but they really don't have a relationship with your family member, it's more an effort to try to get influence with you as a public official, then the FPPC will look through the fact that the gift was ostensibly given to your spouse, for example. And you do need to report them. And the definition of family member is provided here. This is a further elaboration on what I was just talking about in terms of when gifts to your family members will be considered gifts to you. Something that's really important and very valuable, but not considered a gift for reporting purposes is informational material. So you may go to a conference and get a whole lot of valuable content. None of that has to be reported, is considered a gift. But if there are things provided to you in connection with going to that conference, like transportation to a restaurant, the dinner itself at the restaurant, any entertainment that's provided at an invitation-only event, and we'll talk about that as well, that is all considered a gift that has to be reported. If you receive a gift that you really didn't want to receive, or you realize after the fact that it's in excess of the 630, or maybe it's in excess of 50 and you don't even want to have a disclosure situation, you can return gifts unopened, unused. If you haven't used them, you may donate them to a 501c3 as long as no family member is on the board of that or doesn't work for that organization, and you don't as well. And you can also buy them down. I don't think I mentioned buy down on my slide, but buy down simply means pay the value of whatever the gift was down to the amount that then creates a gift that is within the limits or below the disclosure limit. As I mentioned, gifts from family members are not considered reportable gifts, and this defines more broadly who family members are for this purpose, including former in-laws. This is another exception, home hospitality, if with the exception of people who are three little eyes. If you have a relationship with somebody unconnected with your official position and you are invited to their house and they're there and you're afforded home hospitality in their home, that's not considered a reportable gift to you. And home in that instance doesn't have to be their primary residence. It can be a vacation home. But if somebody's not going to be in their own home and they're just saying, oh, go use my home in the mountains for the weekend, that by yourself and enjoy it, that is definitely a reportable gift. And it may well exceed the gift limit. So you have to be very mindful of that. Reciprocal gift exchanges are permitted so long as it's not with a lobbyist who's registered to lobby the agency. So this is food, entertainment, nominal benefits that are exchanged on various occasions, as long as the amount that you're receiving is not disproportional to the amount that you're giving. And then this says that you have to report the excess of the amount provided if the amount is in excess of what you gave, the amount that you received. There are some exceptions as noted here for plaques that have a value of less than 250. If you receive a ticket to an event and you don't use it and nobody else uses it, so it just goes unused, then that's not a reportable gift. And then 2 tickets to admission for a 501c3 fundraiser or to attend a campaign event also are excluded from the gift definition. Employee raffles also are exempted from this definition as long as a third-party provider is not paying for those gifts. If you're giving a speech somewhere and the provider of that, the organizer of that event provides you with some travel expenses, so pays for your meals, just like everybody else's meals who attends the event, pays for your hotel for the night before, day of, and day after, the way that Sackers will for its speakers, if requested, is permissible and does not implicate the gift limits, but it does need to be disclosed on your Form 700 on Schedule E. This has come up where people have where a vendor might pay for somebody's hotel, thinking that they're saving the retirement system money by doing that. And unless it is properly handled as a gift to the agency, which requires specific posting on the agency website, can only be provided under certain contexts, that's a gift to the individual who receives it, which is why Sarah will pay for authorized travel expenses for you. You shouldn't be taking these types of gifts from others. A bona fide competition, including the California State Lottery, is exempted. If you go to somebody's wedding, all of the attributes of being invited to a wedding are not considered a reportable gift unless, as long as you're receiving substantially the same gifts that everybody else who goes. Bereavement offerings that you may receive with the passing of somebody close to you are typically not reportable as gifts. Acts of neighborliness is also an exception. And I like the language in this because it's so easy to understand, even though it's long. So I included it. But it also gives you a sense of the breadth of what a gift would be otherwise. Somebody coming to your house to feed your cat while you're away might not even cross your mind as a gift. But in fact, it would be a gift if there weren't this exception. Bona fide date or dating relationship, unless the person's within the 3 little I's, also is an exception. Acts of human compassion, as described here, also are exempted. With more descriptions on this slide. And as I noted, some of these exceptions do not apply to the folks who do business with MCERA or who would like to do business with MCERA or the registered lobbyists. BFF is another exception, but again, with the exemption for, or the exception for 3 little I's. And then there's this catch-all. I just sort of caution folks that if you're thinking that a catch-all applies, note that you're the one who's going to have the burden of proof on that if the FPPC starts an enforcement action against you and disagrees. If you were to get married during the period covered by your Form 700, you actually have to report the gifts that you receive from reportable sources, but they, assuming they're over $50 in value, but you are not limited by the $630 per source. And you report half the value because half of it went to your partner. This is the rule for other invitation-only parties. So those also are gifts unless they fall within an exception. There are some exceptions for public officials who do what are called drop-in visits, and those are explained. And the group gift rule I've already gone over. So what do you do to keep within the limits? I also previewed this. You can buy down gifts. You can timely return them unused. You can donate them under certain circumstances to 501c3s, and you can refuse them. The Schedule E is the one I mentioned earlier as the place where you report travel payments and reimbursements. So as you'll see there, those sections actually require you to say what it is that makes you fall within this exception. So did you make a speech or participate in panel, for example? You have to identify the date on which you did it and who the source was of the funds. And if it was a 501c3 or not. There's this exception that I already talked through a bit, where you're traveling to give a speech on a governmental topic. And then their travel paid for by a governmental agency or a 501c3 organization can also be exempted under if it meets the various aspects of this public purpose exception. And I've included a lot of that language here. This document is intended to be a resource for you. Though again, if you have specific questions, you can ask the FPPC itself. This is what an expense log might look like to keep track of these sorts of things. And then here are other places to go for help. Thank you very much.
That'll barcode go to you personally, go right to you or?
Oh, I don't know. I guess
Go to the firm.
yeah, right. I don't know. Our people put that on there. I don't know what that is.
Like,
My contact, I guess it's my vehicle. That's new. Didn't notice it. All right. Well, thank you. And I'm happy to answer any questions if you have any more. No? Okay. Thank you.
Thank you.
and with that, we're going, oh, I'm sorry.
Oh, it goes through.
Just a suggestion, you can certainly go to your next item. You could also consider finishing up your last two items. That way, all you're going to do is end the meeting by reporting out from your closed session. And your last items would be future meetings, a training calendar, and the consent. Your choice.
Let's do it in order.
Okay.
Refresh my memory. Go to close session to church for that.
Mr. Wickman, the closed session, do I stay here on the Zoom or?
Oh, that's a good question. Jeff? Jeff?
So he needs to end that session?
Sorry?
Yeah, he hasn't got back to it yet. He's made the inquiry and they're apparently going to get their financial.
Very
Yeah.
You understand?
Sure.
Slowly.
He needs
down.
those glasses.
I do what I gotta do.
Oh, she's got her sweater.
You go in later. Later.
Can anybody hear me?
Oh, he's not.
Joseph, you need to close the session that you're in right now,
Okay,
exit that session.
okay.
And then Chris sent you a second link to a WebEx. You need to enter that.
Got it. Thank you.
Yes.
calling the board meeting back to open session. With regard to item E3, there was no reportable action. Moving on to our article or item E4, future meetings. Are there any agenda items that people would like to see on a future meeting? Then we have the training calendar. Has everyone had a chance to review the training calendar? Is there anything you'd like to
Only just to point out that the yellow highlights are the new addition either of a new conference that's been scheduled or event that's been scheduled, or trustees who have signed up for events. So the only two new events are Calipers has created a human resource roundtable. That's the only additional event that's been added. Otherwise, it's just trustees who have indicated that they are attending future events.
anyone would like to make a motion?
Silverstein will move to approve the training calendar.
Robbie, you'll second?
Any discussion? Would you take the vote?
Trustee Cooper,
Yes.
Trustee Helway,
Yes.
Trustee Martinovich.
Yes.
Trustee Poole,
Yes.
Trustee Robbie,
Yes.
Trustee Silverstein,
Yes.
Trustee Vasquez,
Yes.
Trustee Werby,
Yes.
Trustee Jones.
Yes.
Chair of the training calendar is adopted 9-0. Trustee Jones voting for Trustee Huda.
Which brings us to the consent calendar. Is there anything of note on the consent calendar?
Nope.
It's a
Unless
loaded
you have-
question. It's a loaded. I think I would ask, I think we would ask you that question. Is there anything? of
Well,
note?
we always know that that we see a large number in the return of
Right.
contributions. The person's been advised and.
Correct.
and
That's always the case.
so
Ad-
that-
Advised and they sign a form that they have been.
And
And we
advised.
always provide estimates. So they understand.
That's true. We give people an estimate of what the.
So they can
benefit is that
evaluate.
They're forfeiting.
And again, this is an action item.
So move, Cooper.
Second by Silverstein.
Any discussion? Mr. Administrator?
Trustee Cooper,
Yes.
Trustee Helway,
Yes.
Trustee Martinovich.
Yes.
Trustee Poole,
Yes.
Trustee Robbie,
Yes.
Trustee Silverstein,
Yes.
Trustee Vasquez,
Yes.
Trustee Werby,
Yes.
Trustee Jones.
And that concludes our business. Thank you very much. We are adjourned.